According to a new analysis by Goldman Sachs and their investment team, they looked at the shape of the yield curve and found, shockingly, that it looks like the market is expecting interest rates to go down by a lot, maybe even down to zero. Now, they used an overly complicated butterfly analysis to come to the conclusion that the middle part of the yield curve is what they say rich compared to both ends. And what they mean by rich is there's high demand for that part in the middle. But all you really need to do is look at the sag in the yield curve as it sits right now. And what it tells you is that there is a high degree of demand in the middle. Now, where that applies is that, as Goldman says, it looks like the market is expecting the Federal Reserve to cut rates by a whole lot, maybe even down to zero, because the last time they saw the middle part of the curve and the pricing in it this rich to the ends, the Federal Reserve was at zero. And in other periods in history where you see the same levels, the Federal Reserve may not have been going to zero, but it was heading down by a lot, say, like, for example, in 2001. Also this week, as we look forward to the Federal Reserve and its September meeting, we got three Federal Reserve officials. Now there's a third one saying that we are increasingly dovish. We're increasingly concerned in the wake of last Friday's jobs report that the U.S. labor market has indeed turned a corner. Lisa Cook, who's another Federal Reserve governor, has gone on record saying that she's worried about the state of the labor market, in addition to Neil Kashkari, the Minneapolis Fed president, along with Mary Daly, the San Francisco Fed president. And before them, of course, we had the two Fed governors, Waller and Bowman, who dissented at the meeting. So it is increasingly likely, as we told you last week, Steve and I, to look for Federal Reserve officials to go on record this week saying all of a sudden they're not as worried about inflation, and they're more likely worried about a shift in the labor market, which goes along with what Goldman Sachs found out with the yield curve, and the yield curve saying that interest rates have to go down by a lot. And of course, what we want to say to Goldman is that it isn't just the yield curve, it's everywhere, up to and including now the FOMC, which is looking like it's going to start its next rate cutting cycle, or at least the next part of the rate cutting cycle. So Steve, interest rates might be going down by a lot, maybe going down to zero. I know that you're shocked to hear that from a Wall Street bank, but they're like, hey, oh my God, this is the look at the yield curve shape.
You know, Jeff, I'm kind of reminded by something. And before the show, you're telling me the article, there was this kind of butterfly pattern that, Goldman is referring to. And it's really kind of reminds me of our good friend, Emil Kalinowski, because I remember there was, I can't remember, was it an arching cat or a retching cat? So when we get that sort of symbol, what does that mean for the rates market? Does that ring a bell at all?
Yeah, the retching cat, back then it was Eurodollar futures. And that was one of the signals to, hey, look out, things are changing in the wrong direction. When the cat retches, that's something to pay attention to.
Right. So we have this butterfly pattern now in the yield curve that's suggesting things are going to go down. We might get the retching cat signal. This is going to be fantastic. But yes, Jeff, it's in all seriousness, it's almost a surprise to see Goldman's response to this, because they've been telling everybody that interest rates are going up. And that's a prevailing view, that rates have to go up. And we're showing all of this debt and even more debt. And rates just must go up. In fact, there's a cyclical reason. There's any reason you can imagine rates need to go up. But as we know, this is all about growth and inflation expectations. And what are we hearing from consumers right now? Demand is going down. What are we seeing in the labor market that the Fed can't see? Continued claims ticking up, a little bit, but it's still the path that's wrong, and still the percentage of people that's been on continued claims for as long as they have that's a problem. So again, as I've been saying, again, no surprise, at some point rates are coming back down. The Fed's going to be way behind the curve. And it's not surprising to me that Goldman is saying this, because we know, Jamie Dimon at the competitor bank loves this, because he's loading up big time on the long bond.
Yeah, it's almost like you read the analysis here, and even you should go to and read the report. It's almost like they're over here, as Steve just said, saying interest rates are going to go up. There's more inflation tendency from tariffs. That's what the central bankers are telling us. There's, too much debt is being supplied by the Treasury market or the Treasury Department into the Treasury market. So they're over here thinking rates are going to go up, And then all of a sudden one day they're like, hey, you know what? Let's check the yield curve. Let's check the yield curve shape, because it's probably going to be really steep and tell us that we're exactly what we want to believe. Holy crap, look at that. The middle part of the yield curve is sagging so much, it looks like the yield curve is saying rates are going to go to zero. Where does this come in from? That I think it was that they're almost surprised to find that on the yield curve, when we've been talking about this forever, and it's hardly just the yield curve. In fact, the entire bond market has been saying exactly what Goldman Sachs found out from looking at the shape of the yield curve, from swap spreads to forward rates, and even a bunch of others in between. All of them have said the same exact thing. Over time, of course, we don't know how or when this is going to happen, but over time, rates are going to go down, and they're going to go down by a lot. And through that time, as more and more evidence piles in, it's been very slow and very incremental, but it all continues to move in that same direction. So I think what happened, Steve, and I'll get your opinion on this too, is it was last Friday's or the previous Friday's jobs report. It was the July jobs report came in, and everybody was thinking economy's fine and solid, inflation's our biggest risk, treasury supply. And then the jobs report hits and they're like, maybe we should go back and check some of our assumptions, because they weren't doing that. And so they got the weak jobs report and they're like, let's look at the yield curve. And holy crap, the yield curve isn't even looking anything like what we thought it was supposed to. Before we go on with our video today, let me ask you a question. What if your gold could actually pay you every single month in more gold? That's what today's video sponsor, Monetary Metals, lets you do. And here's how it works. You still own the gold, it's still in your name, it's fully insured, but instead of just sitting there doing nothing, it actually starts working for you. Monetary Metals has built a system that turns idle gold into productive gold, earning real yield paid in physical gold, not dollars. No selling, no trading, no converting. You keep your gold, and every month you get more of it. It's a simple idea, but it solves a big problem. If gold is money, it should act like money, and now it finally can. If you're a long-term gold holder looking for a smarter way to store value, check them out at monetary-metals.com/Snyder. Again, that's monetary-metals.com/Snyder. I highly recommend booking a call with them today to see if they're the right fit for you. We thank Monetary Metals for their sponsorship, but now let's get back to the rest of our video.
Yeah, Jeff, and then kind of we talked about last week that, hey, watch the race market. If you continue to see the front of the curve go down, and then with no surprise, Goldman's like, oh my God, this is shocking. Look at the curve. Why is it doing this? Well, you know the economy is supposed to be booming here. But as we talked about last week, all the non-farm payroll report did was confirm that all the other data was right and it had been wrong. And so that's the challenge here is the rates market is telling us on the front of the curve, financial conditions are indeed tightening. Exactly what happens when there's a dollar shortage because the global economy is slowing down. Long to the curve, not following it yet, but based on what we're seeing here, at some point, long rates are likely to come right back down with it.
Yeah, there's a couple of things that we said in the wake of the payroll report. Number one was watch the front of the curve, as Steve just mentioned, which the 2-year had a huge downdraft on the Friday the payroll report came out. The 2-year is down 25 basis points in yield. So we said, watch that and see what happens next week, this past week. Was it going to hold down where it was after the jobs report? And it did. It's still around 369, 370. And then the other thing was watch for Fed speakers, right? They were going to come out, and we said they're going to come out all over the media and say, oh, yeah, we do like rate cuts after all. We are very much in favor of rate cuts. So as I mentioned in the introduction, Waller and Bowman, Fed governors, they dissented at the last meeting. We know where they stand. And then on Monday, I think it was actually Sunday night, but it was reported Monday, Mary Daly from San Francisco Fed said, I'm kind of tired of waiting. I think I see enough in the labor market weakness. I need to start cutting rates. In fact, what she said was, we have zero evidence for inflation, and we've got a ton of evidence. And she said, piece of evidence after piece of evidence over here for labor market weakness. So there was Daly. The non-voting member, Neil Kashkari, kind of said the same thing. And then to finish it up for the week, we got Lisa Cook from the Federal Reserve Board of Governors, Governor Lisa Cook, who said, this labor market looks like it's at an inflection point, or what is it? She said, they could be at an inflection point. So that was the second big thing that we said to watch this week. The short end of the yield curve was going to drop. It did, and then hold those gains. And then we had a bunch of Fed speakers come out and say, we are now in favor of rate cuts. So, Steve, let me ask you a question. I'm on record saying that I think the Fed is going to cut by 50 in September, given how weak the data has become. What do you think about for the September meeting?
Yeah, that wouldn't surprise me at all, Jeff, because when we talk about we could be at an inflection point, let's talk about that non-farm payroll report, because we see this pattern happen over and over again. You get this deceleration, then all of a sudden it jumps back up, and everyone's like, hallelujah, soft landing, this is it, inflation's the problem. And then all of a sudden it starts to roll over the other direction. Everyone's like, uh-oh. And I think that's what these downward revisions did, is it really kind of woke everyone up that, hey, that soft landing you thought you had, You don't have it at all. And there's no doubt the direction of continued claims, what we saw in the ISM services saying, hey, look, the employment contracted again. Now they claimed it wasn't due to layoffs, it was due to pulling job openings, and that's fine. Okay, pull job openings, that's the first step. Then what do? You cut hours, cut pay growth, cut jobs. But you talk about evidence, Jeff. We got the productivity and we got the unit labor costs this week. And what did productivity do? It went up. Labor costs went down. That's not what you want if you're looking for inflation to rise and you want to see employers hire. No question, they're going to be kind of September. You're on for 50, no doubt. The only question is how much are they going to cut, because where's the economy going to be at?
Okay, let's talk about the other end of the yield curve then. So we said short end of the yield curve, front end goes down. We know the middle part of it. That's where the inversion is really hitting McForth. That's the part that lines up with the swap market to begin with. But how about the long end of the yield curve? Because that was a challenge that the mainstream threw out there. And again, as we mentioned, that was sort of like Goldman's premises that long-term rates should be rising because there's too many treasuries, treasury debt. How much have we heard this past week about treasury auctions? There was a 10-year auction followed by a long bond auction, and both of them were characterized in the mainstream as horrific. Well, maybe I'm overstating a little bit, but they were saying it was ugly. Foreign demand is fleeing. This definitely confirms the fact that people have lost faith in the treasury market. And then you look at the actual market and actual market prices, and you're thinking, if this is losing faith, I would really hate to see the opposite, because even the long bond auction, the results were posted. It seemed to be, it confirmed everybody's worst fears, except the secondary market long bond rate didn't move. It was exactly the same. So again, I think everybody is shocked by what's happening on the yield curve because everybody pays attention to social media and the financial media. And there is definitely this universal narrative that the market is cracking, that the world is rejecting treasuries. But then you go and look at the actual numbers, look at an actual chart, look at the actual yield curve, and the yield curve is unequivocally saying there is none of that. There's no inflation risk. There's no fears over the treasury. What the market is most afraid of is what we're seeing in the jobs market numbers that's confirmed by these Fed officials that are shifting their policies. Everybody's afraid of a situation where interest rates go down and then they stay there. It's not about auctions. It's about economic fundamentals.
Yeah, that's right, Jeff, because everybody is worried about inflation. I mean, we're hearing this, at the producer level. Look, input prices are rising. And the problem is, well, China, let's talk about China. It was a really good example. They said, look, prices on the end producer side going up, consumer price going down, because they can't pass it through. So they're now competing with other producers to drive prices down to keep market share, to stay in business. So you start to look at things like unit labor costs. And this on the top of one of my favorite data points, because it's very clear. If people are getting paid less, which we know in all the other data has been validating that average hourly earnings is on a decline, this validates that what it's telling us is workers can't afford higher prices, which is what we've been saying this whole time. Look, paychecks are shrinking relative to inflation. So yeah, I think you can throw the inflation story out the window. If we do get inflation, yeah, you can go back to global financial crisis and we can see energy prices drove it up. And then what happened? It came crashing down. It's the same thing that's happening. If we do get inflation pushed through the system, it's actually going to lead to less growth. And then, of course, more unemployment, which then, of course, we're going to find out from the Fed that, hey, the employment's now a problem. And then, like always, we're massively behind the curve. So we're going to have to cut 50 basis points.
Yeah, that's the market verdict. It's almost like you're damned if you're doing and damned if you don't, right? If businesses raise prices, volume falls off, and therefore the businesses have to adjust to lower volumes, which means they're going to have to cut costs. They're going to have to cut hourly wages. They're going to have to cut hours. They're going to have to cut workers in some extreme cases, maybe do more of that. And if they don't raise prices because input costs are going up, they're going to have to do the same thing regardless. And so the market is saying it doesn't matter what happens here with tariffs. If they do raise prices, as Steve just suggested, then consumer price rates go up a little bit in the short run, and it leads to worsening long-run conditions. Either way, short-term interest rates from the Fed in the marketplace go down by quite a lot. And so when you're locked into this either or, where both of the outcomes are basically the same, you can see where the market, the curve and the sag and the yield curve is saying, look, we believe no matter what happens here in the short run for consumer prices, it's going to lead us to a path where short-term interest rates are going to go down by quite a lot. And so you look at what Goldman Sachs was saying, what they were really I mean, they were overly complicated what is really a straightforward message simply because everybody seems to want to believe this other thing. Like I said, it's almost like they were shocked and surprised to find out that the actual market was not behaving in the way that everybody says. And so the moral of the story here is to, okay, whatever they're saying off there in the mainstream and financial media, take that with an enormous grain of salt. As Steve, you say this all the time. In fact, more often than not, the opposite is going to be the case. And so when you actually do the homework, you think, well, treasury yields must be exploding higher given the way everybody's talking about the treasury market and these horrible auctions that are coming out. But then you look at the marketplace and okay, it's completely the opposite of what everybody said.
Yeah, it's, I tell people, you got to look at the real economy sometimes. You got to, go out, put some feet on the ground and go see what's going on, because we heard from Chipotle and Starbucks. What did they say? Well, we had to raise prices and then demand went down. And that's what I love seeing about like a lot of these fast food or fast casual reports, Jeff, is look, I don't care if their profits gone up or earnings gone up. I want to see foot traffic. And when they quietly, well, it's down 1 or 2%. And then they comment, look, we know our input costs are going up and we're doing everything we can to prevent from passing it on to the consumer, because they already know the math. And then you look at McDonald's. What did they say this week? Hey, we're really worried about the low-end consumer. But look, we did pretty good because we had to do a gimmick to get people in the stores. And again, that's kind of exactly, I come back to China. It's the same difference of what's going on over there with their producers. How do I get market share? How do I get customers in the door? Because I'm not getting enough new customers, so I got to go steal your customers. And when you get into that position, somebody's going to lose. The economy is going to go down. It's going to slow down, and the labor market's going to get a hit, because all these businesses can only get squeezed so much at the margin before they have to lay people off, which is exactly what the productivity data said today, which is fantastic, because it's saying, look, why are people more productive? It's not because they have more work, Jeff. It's because they have fewer coworkers.
Yeah, and that's the labor data. And I think the biggest thing from the McDonald's report, you mentioned them. Yeah, the same store sales were up and reversed. It was a 4-quarter decline or something like that. But yeah, it was on discounting prices and gimmicks. But the McDonald's management, forget which one it was, the CFO or CEO said, our consumers, our mainstay customers, are skipping breakfast, not because they don't like McDonald's breakfast. They're skipping breakfast because they're skipping breakfast entirely. They're not buying it from McDonald's. They're not eating it at home because they can't afford it. So what they're really doing is saying that consumers are really struggling here to the point that they're actually skipping meals, which is impacting our ability to turn around the franchise and all the franchises, which is again consistent with all of the data that we're getting, inconsistent with the mainstream narrative on inflation, which, if low-income consumers can't afford breakfast, they're not going to be able to afford a higher cost for some services that's raising its price. They're going to cut that service straight away. And so again, you look at what the market has been saying, the evidence that comes in, the sag in the yield curve, whether you want to put a butterfly analysis on it or not, it's visible. You can see it. You can literally see it on the yield curve. The market is saying that the reason why there is so much demand for that middle part of the curve is because over time, we don't know how much time. We don't know exactly how this is going to go. This is the same story we've had. Over time, interest rates are going to go down. They are going to go down by quite a lot. And when they get there, they're going to stay there for a very long time. That's the picture of the swap market. And so the point here is, don't be surprised by that if you actually go out and look at what the market's doing.
Jeff, I'll tell you what, I'm a big fan of McDonald's breakfast. I got to say this. I haven't been in a while. Sausage and egg McMuffin, that's my ticket. But you're right. When they're BOGO, and they're going to be because the economy is going to go down, I'll be there.